James, thank you very much for joining us. Before we begin, we are in fact recording this slightly early. As such, we're going to reflect, I think you're going to speak to the performance of the fund up to on or about the 25th of April. With that in mind, could you kick us off with a summary of how the portfolio has fared to the 25th of April?
Yeah, sure, Richard. I think it's fair to summarise April, if you like, in a broad sense, as being a relatively uninteresting month in the markets, if you like. There's sort of clearly sort of a tide and a move in the markets, but really the outcome is one of nothing really from global equity markets, flat. Nothing really from emerging markets, they're flat as well. Bond markets up a little bit, and as a consequence, the spread of returns from the funds is also pretty narrow as well. We're recording performance until the 25th of April, which is a little bit unfortunate in one sense, because I think the last few trading days of the month are looking reasonably positive for the markets. So we expect it to have a positive effect on performance. Clearly no guarantees on that, it's just until the fund's priced, we don't know that for sure. But the spread of returns is pretty narrow, between plus 0.9 up to the 25th of April for the strongest fund, and minus 0.4 for the underperformer to this date.
Okay, as you've said, there not perhaps a huge amount going on in markets. Certainly, markets kind of ending up where they were at the beginning of the month. However, let's think about what were kind of the main themes last month. What did we see?
There were some interesting dynamics. So within the global equity cohort, you had Japan underperforming quite significantly, US down a little bit, and elsewhere in the developed markets, reasonably positive returns. I think Japan's underperformance is pretty significant on a year-to-date basis as well, and I think a lot of that is a reflection on concerns about, obviously there's VAT changes there, but also whether the third arrow in RBA's reforms, the structural reform, whether that will be a success ultimately, I suppose. In emerging markets, again, some big variations in returns. Emerging Europe, I think, impacted by the Russia and Ukraine ongoing crisis there, understandably. But LATAM, and particularly LATAM and Asia as well, actually, correspondingly doing very well. And again, so the market was flat in emerging markets as a whole. Within the fixed income markets, government bonds did pretty well. Credit did okay as well, and emerging market debt did pretty well. Property had another strong month. I think that was the best performing part of the listed sector, if you like, that did better than the global equity market over that period.
Okay. In terms of where the portfolios are today, where they were during the majority, as we say, of April, what were the kind of main asset allocation drivers? What was working? What were you positioned for?
Well, the aggregate equity positions didn't really impact the portfolio very much, but you did get a bifurcation in returns when we look at the total returns of the funds, really based on the sort of a hemisphere of the predominant investment of the funds. So the funds that are predominantly investing in the northern hemisphere, the US funds, the UK funds, European funds, were in negative territory over that period, influenced in a large part by the movements in their domestic equity markets, whereas the southern biased funds, the Asian funds, the Australian fund, actually are in positive territory up to the 25th of April. So the local moves in the equity markets are very important, but again, equity in aggregate, flat, emerging markets in aggregate, flat, so that overweight to emerging markets versus developed markets won't have helped in the portfolios very much over this time period. Also, the overweight in cash doesn't really make a big difference in absolute terms over these kind of periods as well. We will get some benefit from the government bond markets, not directly really, because we don't have much in the way of government securities in the fund, but we will get a second derivative of that. The credit markets are influenced by the movements in the government bond markets. They're priced off that yield, so we should get a help from that yield compression over the period. And emerging market debt did well again. It's an asset class we've bought within the last 6 months. We think it's cheap, and it's certainly proving to be a rewarding asset in the funds at this time. I mentioned already property securities. Just to reiterate again, the fund does hold a decent amount of property securities. We're underweight compared to our long-term asset allocation targets, and we mitigate that to an extent by using infrastructure securities. But being underweight property in a month where property does well, clearly that's a bit of a drag on performance. But it is, it's reasonably marginal because it's a 3% underweight. It's not a massive one, but it is something that will detract from performance slightly over that period.
Absolutely. Did you like to make any changes to the portfolios? Maybe you've got some new ideas in mind and stuff. Could you just expand on that?
Yeah, well, I mean, in a world where most things are flat over a given period on average, unless your view of the world has changed materially, you wouldn't expect to make many changes in the portfolio. And as a consequence, we haven't done very much over the last month. It's a reasonably short time period, of course, as you know, but we remain neutral to equities on the whole, with an overweight to emerging market equities, heavily underweight government debt. They still look pretty unattractive, even though yields are starting to sort of become slightly attractive in certain markets, even in the very sort of core sovereign areas. Emerging market debt is an interesting position. As you know, we haven't changed that, we still hold it. And then the credit positions, a bit of investment grade. We sold our high yield recently, we've covered that a number of times in these vodcasts. Strategic bonds and convertible debt, which has a pretty high sensitivity to the equity market, but with a nice bond floor, which helps us when we get periods of equity market weakness. So that's really how we're positioning the funds today.
Good stuff. And then finally, looking forwards, what are you perhaps seeing?
Well, it is a difficult time for us multi-asset investors. We never say it's easy, but it does seem quite difficult at the moment. You've got equity markets which have run for about 18 months, notwithstanding the last 4 months where they've not really done anything, which in some ways is a healthy period. Gives you a time to consolidate, gives some time for earnings to catch up with the price movement over the last 18 months. And in fact, corporate sector does look in good shape. The news coming out of the corporate sector is generally pretty good. The economic backdrop, now clearly there's not a sort of a one-for-one relationship between what's going on economically and what you achieve as an investor, but it is a positive backdrop which should spell or forecast bode well for corporate earnings. And also, I think, interestingly, the amount of M&A activity has increased materially over the last 6 months, let's say. We're back to levels which we haven't really seen since prior to the global financial crisis. And in a world where valuations aren't stretched, they're not cheap, you're getting a lot of M&A activity, you've got economic green shoots, you've got a consumer returning to the party. You can make a reasonably constructive case for equity markets today, even though valuations are clearly not as cheap as they were 18 months ago. We still don't think government bonds are attractive at these levels, barring a couple of sort of particular niche bonds. We think high yield remains expensive, but there are other elements of the credit market that do provide us opportunities today. And so that's really where we continue to focus our efforts. Look for good value, opportunities to exploit, but remain diversified. Don't put all your eggs in one basket and keep a variety of bets in the portfolio at any one time.
James, thank you very much.
Thanks, Richard.